Hi friends, welcome to Investigating Investments. I'm Katie, and today we are going to be talking about the 8 things that you should be considering if you're trying to decide if you want a 15-year or a 30-year mortgage. Number 1, the term length. The 15-year mortgage obviously takes you 15 years to pay off, while the 30-year mortgage obviously takes you 30 years to pay off. Number 2, the interest rate. 15-year mortgages have a lower interest rate than 30-year mortgages because the 15-year mortgage is less risky for a bank because you've agreed to pay it over a lesser amount of time. Therefore, the 15-year mortgage will have a lower interest rate than the 30-year mortgages will. Number 3, the payment amount. The 15-year monthly payment is substantially more than the 30-year monthly payment amount. And that's because you have the whole mortgage plus any interest that you have to pay off in 15 years versus the 30-year mortgage. You've got that mortgage spread out over 30 years plus the interest. However, because you're paying that mortgage off over 30 years for the 30-year loan, you have to pay substantially more towards the loan overall because that's a larger amount of time that you have to pay interest on that loan. Number 4, opportunity cost. So let's say your 15-year mortgage costs you $500 more a month than your 30-year mortgage. So here's the question. Is it better for you to get that 30-year mortgage and invest that $500 a month? Or is it better for you to get that 15-year mortgage, take that $500 payment, and apply it towards the 15-year mortgage? In order to answer that question, you really have to ask yourself another question. What is the rate of return that you can get from that $500 a month? If you invest it, what is that rate of return? And if that rate of return is greater than the mortgage interest that you're being charged, then it very well might make more sense for you to get that 30-year mortgage and invest that $500 a month versus applying that $500 a month towards your 15-year mortgage. Number 5, inflation-induced debt destruction. This is a term coined by Jason Hartman. So inflation, what is it? So I've got this $20 bill, and let's say I take this $20 bill to the grocery store and I buy $20 worth of groceries. If I were to take this same $20 bill, and if I were to go to the grocery store 15 years from now, I would not be able to buy as much groceries with this $20 bill as I can today. And if I waited for 30 years, and if I went to the grocery store, I would be able to buy even less stuff than I could at 15 years from now. So why is that? That's because the US government keeps printing money and the purchasing power of the dollar decreases over time. So in the same way that the purchasing power of this $20 bill decreased over time, your mortgage will also decrease over time with respect to the currency supply around it. So with this in mind, the 30-year mortgage is more advantageous than the 15-year mortgage because the 30-year mortgage will be able to take more advantage of this inflationary effect than the 15-year mortgage will. Number 6, qualifying for future loans. Whenever you apply for a loan, including a mortgage, the bank will typically need a list of your current monthly loan obligations. And so they will look at whatever loan monthly payments you have, and they will be asking the question, okay, here is how much money you make a month, and here is your monthly loan obligations. If you add this extra loan that you're applying for, does that ratio make sense? And if that amount would tip the scales too much, then that bank may not lend you that loan. Versus if it's lower in whatever proportion they deem reasonable, then you'll be able to move forward with the loan application process. And so with that in mind, if you get a 30-year mortgage, you'll have a lower monthly payment than the 15-year mortgage. And so if you think that you might be applying for a loan at some point in the future, during the course of your mortgage, you might want to go with the 30-year mortgage so you can be able to afford, according to the bank, more loan than you would be able to afford with the 15-year mortgage. And if you're like dead set on, I want to pay off my mortgage in 15 years and nobody's going to tell me otherwise, like you can always get the 30-year mortgage and then just pay it off as if it was a 15-year loan, because when the bank looks at your obligations, they would see whatever the payment amount is for your 30-year mortgage. And even if you're paying it off at a faster rate, they would see that lower 30-year mortgage amount. And then you would be able to be approved for more loan in the future. Number 7, mortgage interest tax deduction. This is where you can reduce your taxable income by the amount of money that you've paid towards the interest part of your loan over the past year. So, for example, let's say you made $70,000 this past year and you've paid in total $5,000, not towards the mortgage overall, but like just towards that interest part of your mortgage. So then what you can do is, instead of paying taxes on that full $70,000, you can actually reduce that $70,000 by that $5,000 you've paid in interest, and you only have to pay taxes on $65,000 for that year instead of the full $70,000. So this can be a good thing to keep in mind when you're trying to decide, like, should I go with the 30-year mortgage, the 15-year mortgage? The 30-year mortgage, you have to pay a lot more interest overall for the 30-year mortgage, but at least you get to take advantage of this tax deduction. And number 8, the most important one, your personal goals. So maybe you are 15 years from retirement and you're like, oh, I just really want to not have to pay my mortgage when I'm retired. So maybe it makes more sense for you in that circumstance to get the 15-year mortgage and just force yourself to have it all paid off by the time you retire. However, maybe you're more in my boat. I have 2 mortgages. Both of them are 30-year mortgages. So why is that? Because I've looked at the numbers and I would rather have that extra money and use it to invest rather than pay it to a bank, because I've looked at the numbers and it makes sense for me, and I will end up with more money at the end of the day if I invest that extra money. So I highly encourage you, ask yourself, like, what are your goals? What are you trying to accomplish? What makes sense for you? And just really sit back and think about it and make that decision for yourself. Thank you so much for watching. I hope you got tons of value out of this video. Hey, if you did, smash that like button, hit the subscribe button. The YouTube algorithm loves it, and so do I. And until next time, folks, happy investing.